Hello and welcome to the latest Structured Finance in Focus podcast. My name is Greg Kabance. I'm Managing Director of Fitch's Global Cross-Sector Group. And today I'm speaking with Kevin Lopez, who's a director and leads our ratings portfolio for oil and gas PDP securitization. So we're going to talk a little bit about these transactions and really the uniqueness of some of these. Just by way of backdrop, Fitch has rated close to 30 transactions totaling just under $10 billion over the past 5 years or so. And the reason there's really little public knowledge is that the vast majority, maybe 80, 90% is really done in the private market. And most of these are kind of sponsored by private equity companies. So you haven't seen a lot of this information out there. But we've been looking at this for quite a few years. And the basic premise regarding our credit thesis for these is really that a PDP type transaction with that type of production, because it's stable, it can provide a very stable cash flow stream for fixed income investors. Now, provided it's properly hedged, provided you take into account potential expense volatility. But I think it also, which is important on the other side of the equation really, is that it offers issuers a more stable capital source as compared to some of the kind of typical RBL facilities that banks have offered. Now, overall, due to the higher operating risk, most of the transactions have been rated in the BBB single A category. There's a small subset that are mezzanine tranches in the double B category. We have had no negative rating action. There's been a couple transactions that have triggers, but really those are structural protections, which we believe actually enhance the overall kind of protections that investors will have for this. So I do want to go to Kevin here now because we actually did update our criteria recently. Maybe, Kevin, you could just summarize some of those enhancements, if you will.
Sure. The majority of the changes were to provide the reader with a little bit more insight into our approach and the things that we look at as part of our analysis. We elaborated more on such topics as how we analyze OPEX, the things we consider when we look at basis differentials, concentration risk, and essentially our approach to surveillance. One of the big changes that we made was we kind of shifted the main driver of our analysis to loan life coverage ratio from DSCR. However, we think that this is a better metric to look at when we're looking at the issuer base case, our Fitch base case, and our stress scenarios. We still think that DSCR is very important, especially in the IE case or in the Fitch base case. But when we're looking at our stress scenarios, it's not really a good measure of the actual credit of the transaction. The last change that we made is moving from our Fitch base case, we moved from strip pricing to our Fitch corporate price deck. Now, this is a pretty big change because our Fitch corporate price deck is a little bit more conservative than strip pricing, generally speaking, but we think that this is the appropriate move going forward.
Yeah, and I think just the one thing you mentioned about LLCR versus DSCR, I think LLCR allows us to kind of compare deals a little better. It also takes into consideration kind of amortization profiles, decline profiles, and it's kind of an apples to apples comparison. So that's one of the reasons why we did that. Now, many of the transactions we've looked at, we have a ton of information, as you said. So just explain a bit about some of the data we use to kind of come up with how do we review our criteria in general and what are we looking at there?
Well, we have a lot of transactions and surveillance data to go with those transactions. So that allows us to kind of take a look to see, well, what have we done in the past? And was that the appropriate way to look at these transactions? That allows us to take a deep dive into how we looked at production, how we looked at expenses, were we correct in our approach to differentials in the past. It also allowed us to kind of reevaluate, was it appropriate to use strip pricing or should we have done something else? And we went back through every transaction that we had in order to come to kind of try to update this to make it more fulsome for our analysis.
Yep. And I think, most of what we've been looking at, I'd say fit a certain band of characteristics. One thing we've started scrutinizing more is kind of concentration, but maybe you can comment on what we're seeing now. What are some of the evolutions? The asset class has been around for 4 or 5 years now. So what do you think we'll start seeing in the next couple of years? Because I think there will be some evolution.
Yeah, I agree with you. I think one of those, as you mentioned, one of those big topics is concentration. With that, we have two different kinds of concentration. One is maybe we get a smaller set of wells, that's diversified wells across, in terms of value, across the portfolio. But other transactions could probably have concentration risk with a larger set of wells where more of the value is concentrated on maybe just a few wells or something to that effect. We've made some changes in our criteria which kind of allow us to look at that. We set up an HHI index given our portfolio to kind of determine whether that concentration will be an issue or not. And it lays out how we would kind of make adjustments if that were the case. Another thing that we could see is new geographies in general, whether we're talking about onshore or offshore. That's something that's probably going to come up. Also, jurisdictions that we haven't really operated in before: Alaska, California, Canada. These are all possibilities. Wells offshoot could be midstream, which makes a lot of sense in terms of how it relates to PDP securitizations. That could be something that comes to us. And we expect, new and innovative transactions coming through. Right now, our pipeline is pretty full. We expect a lot of issuance towards the second half of the year. And, we expect some new innovative transactions.
Yeah, I think that's a good point. One thing I would just add there is that it's a bit of a continuum because our group actually looks at single platform kind of FPSOs offshore Brazil, which is very concentrated. And this criteria was set up to be very diverse. And we're starting to see things somewhere in between. So we have the tools kind of to analyze it and the experience. It's just we're starting to see differing various types of different structures. I think offshore, you mentioned even just Gulf and other areas. So I'm going to leave it at that, but I'll conclude. And thanks, Kevin, for joining me. And all the listeners, thank you for listening to us. Stay tuned for other upcoming podcasts focusing on structured finance over the next couple of months. Thank you.